Hello, everybody, and welcome to the monthly market memo for the month of October 2025. I'm Kay Seichenberger, the Chief Investment Officer with Retire Path Advisors. And in today's short video, we wanted to walk through some of the market returns, an update for the month of October and year to date, and some of the key themes and catalysts that were driving those returns for the month of October. A little bit of what to look forward to close out the year and also hit some of the more frequently asked questions that we get from you, our investors, and also that we're hearing out in our investment landscape. So, without further delay, let's go ahead and jump into it. And I wanted to just start with some more good news. This slide really hasn't changed much from the last few months, besides me just updating the names of the months. But the stock market melt up, as I call it, continues to move higher. It is a melt up because stocks are over 20% higher, perhaps 30% higher than where they were at the lows of April of this year. And we've just seen spectacular returns month over month. October was really no different. As I wanted to show here, there was about 2% returns across the board for equities. The S&P 500 was the highest returner, if you will, the highest market for the month of October, up a little more than 2%. But everything beat cash again, and that is another good month. We'll take it for global investors like ourselves. Now, for the year, it's basically the same thing, but you'll see year to date, it's the international stocks in your portfolio that are most likely doing the best. Now, they are up close to 28, 29%, in some cases, like emerging markets, up over 30% on the year. Just incredible returns there, incredible returns from their currencies, from promises of more spending overseas, which has boosted animal spirits over there to invest in their companies as well. But one thing I didn't circle here, I wanted to share with you is bonds. Bonds are up over close to 7%, and everything is beating cash so far this year. So really good, just good returns across the globe for the year to date. We'll see if that can continue in November. We believe it will, as we are entering a very seasonably strong part of the year. Some of the best months typically in the stock market will happen here in November and December. So something to look forward to for the last couple months of the year. But what were some of the key themes that we saw? Now, obviously, the big one is the government shutdown. This does have an impact to financial markets. It really hasn't had an impact on our stock or bond markets. As I just showed you, they've moved higher. But workers are furloughed. They are going without paychecks. Typically, they get back pay when the government reopens. But the big thing for us and for me is it has halted the data. We are not getting data from certain government agencies around inflation or jobs, et cetera, et cetera. So it's been a big kind of delay on some of those data uh, numbers that we get every month. Now, we looked at the past government shutdowns. I think this is interesting that we'll show you is the average typically is about 9 or 10 days. The government's going to be shut down. I'm recording this on Monday, the 3rd of November, and we're probably going to be at 33 or 34 days here, matching the longest in history, longest shutdown in history, which was last time in 2018. So we'll more than likely hit 40 days of government shutdown. And again, this really just has a big impact on potentially a big impact on the data that we get, which helps us make decisions. It helps guide decisions of the government, guides decisions of their spending, and also a little bit of potential GDP decrease hit, if you will, for all the workers that are without paychecks. Now, all the research we know and we've looked at shows that that does typically come back as they get their back pay, they start to spend again. So no big financial disconnect here or economic disconnect, just more of a annoyance of what's happening in DC and annoyance that we can't get the data that sometimes we depend upon to make longer term decisions. But we do get private data, and that has helped. So nothing to be too concerned about, but we hope that this shutdown does end sooner than later. So the other big theme for the month of October was just last week, the Federal Reserve cut the overnight rate, or what you see at your bank, maybe what you get at your CDs, what you get on your cash. They cut it by 25 basis points. This is the second rate cut in 2025. We started again resuming this rate cut cycle last month, and right now we're between 3.75 and 4%. Usually you split the difference there and you get to about 3.87% is the federal funds effective rate. So it has moved down from over 5 from a couple years ago, and now we're getting back more into more accommodative, neutral policy, which is good news for stocks and bonds going forward. But the hard thing is going forward in December, January, and those next couple Fed meetings, without that data that we talked about from the government, it is going to make their job a little bit more difficult to continue to cut rates if they can't get numbers on inflation or jobs, which are their two main mandates. So we can look at this by odds of a rate cut. Now, what I wanted to show you here is just how this has changed over time. So again, December, the market was really expecting before that Fed meeting last week on October 28th, about a 90% chance of another rate cut coming in December. The Fed meeting came back. Federal Reserve Chairman Jerome Powell said, "Hey, we're far from certain this is going to be another rate cut. We just don't have any data to back it up." And those odds dropped precipitously down to about 63%, or right now, or maybe around 2/3 of a chance. So still a good chance, but not as much high as it used to be. And we're still in the camp that they will cut rates, but I think he just wanted to pour some cold water on that to give the market something else to think about. So we'll see how November progresses here. No meeting in November. December will be the next Fed meeting and the last one of the year, and we'll see if they cut rates. But there'll be a lot more to digest in the next video to see where we're at there as far as rate cuts go. Now, to talk a little bit more about that, their two mandates for the Fed are, again, low prices, meaning low inflation, stable inflation, around 2% is their guidepost. And right now, they're really not hitting that. The CPI year over year is at 3%. If we just look at the last 3 months, that trend of change is at 3.6% annualized. So they really aren't making a lot of progress anymore on inflation numbers. Shelter insurance is coming down, which has been a big benefit to keep them anchored where they're at, but we're not really moving closer to 2% target right now. So that's maybe the bad thing. The good news is if the unemployment rate still continues to be around what they expect it to be. Their central tendency, or if you will, of what they expect for the longer run unemployment is somewhere between 4 and 4.3%. And as you can see right now, we're right at 4.3. So we're at the upper end of that central tendency. And it has made the Fed a little bit more nervous about the jobs, the unemployment rate moving higher, less jobs being created. They want to focus more on that side of their mandate, which has led them to cut rates. And we still think that they will in December because unemployment is probably likely to stay where it's at or move a little bit higher. If they do cut rates, we believe this actually gets them closer to neutral, which is where Federal Reserve Jerome Powell and the committee believes they should be. They don't need to be restrictive anymore to cut down inflation massively. They don't need to be accommodative to spur a lot of growth. They really want to be more in that neutral. And we believe that neutral band, if you will, is about 1%, which is 1% or the federal funds rate minus inflation, or the federal funds rate minus inflation expectations, whatever you want to look at. It should be close to 1% is where typically neutral is at or has been over the last 50, 75 years. Right now, with this last cut, we're about 1.5. If we cut again in December, we get down closer to that neutral. So even without the data, the market still expects it. I expect it for now that December is a live date for a rate cut, just to get them closer to neutral where they want to be. And then let's stop and reassess in 2026 to see where we may be getting some new data and where jobs and inflation will be. So something to keep an eye on. We'll keep an eye on for it for you. And just to point that 1% out there, but we'll keep an eye on it for you and talk about it in our next month video for sure, because these do have big financial impacts on stocks and on bonds. Now, one of the biggest questions we've been getting to kind of wrap up this video is, you may be hearing it like, are we in a bubble, or are valuations too high here in the United States? Does this mean that future returns, tomorrow, the next day, the next year are going to be much lower than where they're at now? Now, it is very true that the price we pay for earnings, or we call that valuation of the S&P 500, has been steadily rising for the last several years. And it is approaching an area that we last saw at the financial bubble in the dot-com bubble of 98 and 2000. Now, I'm going to draw that line here. we're getting close to that point of where valuations were at. But there's some things we can do to kind of manage that. And then I'll show you here in a second. But nothing to get too concerned about. Valuations change over time. If our biggest companies in the S&P 500 can deliver on the earnings that the market expects them to, we'll actually see that number come down. So this will change over time, but it's just gotten a lot of news here in the last month or so, and something I wanted to address. Now, typically, these higher valuations can mean lower returns in the future. The problem is, in the short run, it's anybody's guess. It's really hard to tell if those will happen. There's really no relationship between a high valuation and a low return next year, right? So what you're seeing here is just a bunch of dots that kind of scattered everywhere, just telling us there's no relationship between high valuations and returns for the next year. So again, nothing for us to be too nervous about right now because um, we're still in a very good spot as far as earnings go for the market. But going out longer term, there does appear to be some tighter fit, meaning that those dots get closer to kind of a central tendency point there, and we see a little bit higher relationship for the next 5 year returns. So all this means is maybe 5 to 10 years from now, we should expect a little bit lower returns in our S&P 500 companies. Now, I think that's good coaching. That's something I, as the portfolio manager, needs to keep in mind. The good news is there's a lot of areas that are on sale and not at high valuations. And those are some areas that we are excited about for the next 5 to 10 years that we are diversifying your account towards in less expensive areas. For example, small and mid cap companies here in the United States. I'm circling them here, but you just see that line, their lines, green and blue, are much lower than the red. That just means that their valuations, the price you pay for their earnings, are a lot less expensive than large cap companies. So what can we do if we believe these large cap companies are too expensive? We can definitely allocate to some areas that are less expensive. Small and mid caps are one area that are there, and they typically, can do better if the Fed is cutting rates and we don't go into a major recession, which I don't believe will happen. We'll wait and see, of course. And then finally, international stocks. International stocks have had a gangbuster return of 2025, as I showed you to begin this video, but their valuations are still very much on sale compared to the S&P 500. Again, just circling that part where that line is much lower than the S&P 500. So the price we pay for their valuations are much cheaper. I'm sorry, the price we pay for their earnings are much cheaper, and they've done really good returns here for 2025. So international stocks are an area we've upgraded recently, we've added to. It's an area we do like for the short to intermediate term. So these are just some areas within equity still we can help diversify you in case there does happen to be some low returns in large cap companies going forward. And then the other question I got was, if we are in a bubble, if we do see a major stock market correction, how do we manage risk within that? Now, I believe that there's not one size fits all for this. So there's a lot of things we can do and what we do. We do look at low correlated securities, bonds and cash. They bring extra diversification. If it's low correlation, that's just a fancy word for saying that when stocks go down, maybe bonds go up, or vice versa, or maybe they don't go down as much, right? That just means it's a good tool in our toolkit to help manage your risk. And I wanted to visualize that here by looking at just the drawdown we've experienced in stocks so far this year. It's been a really good year for stocks, but it wasn't without any risk, right? We saw 20% close to a drawdown in April there at the beginning of April in the S&P 500. Now, bonds on the other side of the spectrum had a not so great year a couple years ago, but this year up 7%, and they've actually done a very good job of managing risk. As I put that line across here, the red, you see it's much more shallow as far as its drawdown, and typically maybe it's even sometimes gone up when stocks are going down. So that's job number one, bonds and cash. They brought diversification there. And then we also look at other risk management techniques in your account to help guard for this. We look at options contracts within some of the funds we own by buying covered calls and getting income from that, or buying protective puts on stocks that may benefit if stocks go down. Those puts actually make money, and we can offset some of the losses with the gains there. So just a really good year. It's not without its questions, though, right? The last question is, are we in a bubble? I don't believe we are. I think earnings catch up from here. I think valuations don't get too expensive. And I do believe that there's other areas we can diversify too to help that. And then just manage risk around stock, cash bonds, and alternatives with options are a great way to have a little hedge there. So with that, I'll leave you and thank you again for watching this. We approach the management of your complete financial landscape very seriously. He's a trusted steward, advocate, confidant. We're completely committed to you, the client. Please reach out to us with any questions. I'm always available. Your financial advisor, of course, is your go-to. You can find a lot of things on our website. I do a lot of writing out there as well to maybe address some of these. And I'll put a written version of this video on our website as well. So with that, I hope you have a really good November, a really good Thanksgiving, and I'll talk to you all again in about a month. Thanks again, everybody.